Hi, I'm Melissa Kane, and I'm with Robyn Pie, and we are with Mueller Pie and Associates. Today we're here at Oasis Brewing and Barbecuing, sampling some of their beers and enjoying their barbecue. We're here today to kind of give you some background on the 2025 sunset provisions. Robyn here is going to go into a little bit more detail about what all that means for you.
All right, so let's start with the Tax Cuts and Jobs Act of 2018. So you probably remember there was a big tax change several years ago, 2018, and some of the provisions within that tax law are set to what we call sunset at the end of 2025. So that means those provisions go away at the end of 2025. So probably the biggest impact that those sunset provisions are going to have on business tax returns is the sunset of the qualified business income deduction. So if you remember, the qualified business income deduction is a 20% deduction on the net profit from S corporations, partnerships, and sole proprietorships. So effectively, those entities that I just mentioned are paying tax on 80% of their income instead of 100% of our income. At the end of 2025, that qualified business income deduction is set to sunset or go away.
Now, as she just talked about what is affecting the businesses, there also are going to be some provisions that are going to affect your personal return. Probably one of the bigger changes that everybody wants to know about is there will be an increase to the tax rates. The lowest rate at 10% will stay the same. However, all the rates after that are jumping between 3 and 1% a year up, to where previously 37% was the highest tax bracket. You're now going to see the highest tax bracket at 39.6. Previously, before 2018, you may remember that we had personal exemptions and your standard deduction, which if I drop back a little bit, on your return you could either take an itemized deduction or a standard deduction. But if you didn't qualify to take your itemized deductions, you could take the standard deduction. For this past year, it was around $24,000. That is going to drop back down to $12,000. However, previously, you were getting a personal exemption, which those went away after 2018. Those will come back. And so each person, a dependent, is going to get a personal exemption of around $4,150 per person. The final thing that we'll probably see on your return is the child tax credit. We've all just got used to having an inflated child tax credit this past year. You saw children 6 and under, they were getting $3,600, where anybody else between 6 and 17 was seeing $3,000. That will jump down to $2,000 between 2022 and 2025. Regardless of age, there will not be a benefit to having younger children under the age of 6. Everybody 17 and under that qualifies as a dependent will get a child tax credit of $2,000. And so far, what we're reading is that after 2025 and beyond, it will also stay at $2,000 thereafter.
The three major components of itemized deductions, property and state income tax is one category, mortgage interest, and then charitable contributions. And those things combined make up your itemized deductions. So prior to 2018, a taxpayer could deduct all of their state income tax, all of their property taxes, and then when 2018 tax law came into play, that deduction was capped at $10,000 per taxpayer. So huge change there, both for our Colorado clients and our Texas clients. Colorado, of course, has a state income tax, and then Texas has a property tax, which is pretty substantial. So that impacted a lot of our taxpayers. Something else that's impacted a lot of taxpayers is unreimbursed employee expenses. So prior to 2018, a taxpayer could deduct as a miscellaneous itemized deduction the unreimbursed employee expenses. So for instance, if your employer required you to travel for work but didn't reimburse that mileage or those expenses, you could deduct those. 2018 came along and the IRS did away with that deduction completely. So 2026, that deduction is set to come back. So the final big change is the reinstatement of personal casualty losses. So prior to 2018, if a taxpayer had a casualty loss, say from a hurricane, to the extent that insurance did not reimburse you, you were able to deduct those excess costs as an itemized deduction. That has gone away for 2018 through 2025, but is set to reinstate in 2026. So then, last thing I want to talk about is the estate tax exemption. So as most of you know, when a taxpayer passes away, they are taxed on the net their net worth at the time of their passing. So the current estate tax exemption is $12 million. So that means an individual can pass away owning $12 million worth of assets, and there is no estate tax assessed upon that person's passing. Well, that $12 million is set to revert down to $6 million in 2026. So that's a big change, again, not affecting a ton of taxpayers, but is something to be aware of if you're in that high net worth group. So thanks again for joining us. We hope that you'll jump out to YouTube and check out some more of our videos on having an IPA with a CPA. Thank you.
Thanks.